China is the world's largest real estate market. According to Goldman Sachs, the total value of the Chinese property market sits at an estimated $52 trillion, twice the size of the US residential market. With thriving megacities like Hong Kong, Shenzhen, and Shanghai, plus a rapidly growing population, the new heirs of the Middle Kingdom have traded farmlands for penthouses. China's rate of growth since economic reforms were first implemented in 1979 have been an incredible testament to the power free markets can have in bringing prosperity to a nation.
The changes in China over the last 40 years constitute one of the best case studies in existence of the benefits of free markets, supporting private property rights, engaging in free trade, eliminating regulatory burdens, and lowering taxes. 40 years ago, about 90% of the population in China lived in poverty by most Western standards. For example, Shenzhen was a fishing village with about 30,000 residents, and they were struggling from one week to the next. It was designated a special economic zone as a sort of test by the Chinese government in 1980, and today it's home to nearly 13 million people. Poverty is nearly non-existent, and the standard of living is roughly comparable to that of most US states.
Although China is functionally still a communist state, this shift towards more market-based decision-making has undoubtedly made the country stronger and financially more resilient than ever. During the fallout of the COVID-19 pandemic, most of the developed world experienced aggressive economic contractions, with one exception. In 2020, the People's Republic of China actually experienced a GDP gain of 2.3%. A big factor in that sustained growth was property development. Modern supply chains have opened millions of new trade opportunities, and there's a new gold rush for land industrialization. Today, roughly 150 urban mega developments, or new cities, are being constructed in 40 countries. But this figure doesn't include China. There alone, an estimated 500 new cities are being constructed. High-speed railways, state-of-the-art airports, factories, and lots of residential real estate. In a report published by the Peterson Institute for International Economics, non-residential real estate, like office buildings, parks, only accounts for roughly 30% of total Chinese real estate investment. The remaining share of the $52 trillion market is residential investment. Last year, nearly 64% of China's population reportedly lived in megacities. This wasn't the case 4 decades prior. The Chinese economy is undertaking the fastest and largest industrial revolution ever seen in history, and that's resulted in a lot of capital for property developers. But now, as the Evergrande Group collapse continues to unfold, Wall Street is watching closely to see if the Chinese property sector is experiencing a hiccup, or if the bubble of all bubbles is about to pop. In September, more than 90% of China's top developers reported a 36% decline in sales on average. This signifies that despite state-owned media downplaying the situation, Chinese firms are struggling to hold investor confidence, and the possibility of a global contagion effect continues to loom over economists.
Initially, there'll be some panic as large firms, whether we're talking about banks or hedge funds all over the world, attempt to figure out what their direct and indirect exposure to Evergrande or other Chinese real estate firms are. And that will take the form of either them actually owning paper of Evergrande or related firms like bonds or commercial paper, or having funding exposure. In other words, if they are receiving funding from firms that own that paper, they'll be concerned about whether to what extent they're exposed and have to take losses. The direct impact of the Evergrande crisis or collapse and how it appears is going to depend upon two things, at least initially. The first is how much of the paper issued by Evergrande is held by U.S. financial institutions, whether that's conventional firms like investment banks or asset managers. And the second is whether and to what extent a recession in China disrupts international trade. The way the Chinese government handles the Evergrande crisis is going to demonstrate to future investors how China is likely to deal with future financial collapses, whether it involves major firms or that sort of thing. So behaviors and really the future of foreign direct investment in China is going to be set to a large extent and behaviors adjusted according to how they handle this.
Another question being asked is how the Bank of China's trend of injecting massive liquidity into non-occupied developments plays into this crisis. These remarkable sites documented across YouTube consist of skyscrapers, highways, and apartment blocks that span for miles, and the total population is 0. Developers like Evergrande are so aggressive in their expansion goals that they even sometimes demolish old ghost cities and reconstruct them with brand new funding. But the ghost city model isn't just isolated to the east. Actually, it's much more common than you might think.
Ghost cities are usually the result of attempts to create the benefits of urban centers and rural areas. I say usually because, for example, there are abandoned cities elsewhere for other reasons. Pripyat near Chernobyl, for example. But historically, the establishment of cities has been an emergent phenomenon. They tend historically not to be planned. If you look at some of the major cities, the vast majority of major cities in the world, you find that there are locations which are socially and economically important. While ghost cities in China are massive and numerous, they're all over the place. I mean, we have ghost towns in the American Southwest, which are similar phenomenologically, and also like Hashima Island off the coast of Japan. There were mines there, and once the mines were exhausted, people left. China has attempted to redistribute the benefits of built-up settlements by building cities in distant and far-flung areas. And many just haven't attracted residents. There's simply no reason to move there. So efforts to create pop-up cities in the middle of undeveloped regions have and suffer from all the same shortcomings as other forms of central planning. Bureaucrats simply don't have the local knowledge to design such things. So unoccupied and large, they tend to resemble, if not actually embody, malinvestment.
The hybrid Chinese economy is very young, and being mostly made up of first-generation wealth, sudden downturns like this one can be ruinous. This new challenge for Xi Jinping will be an interesting case study for the mixed economy model in China. As of now, the Communist Party has taken full control of the Evergrande situation, similar to America's reaction to the 2008 mortgage crisis. But the long-term effects of the Evergrande debt restructuring is estimated to be much larger, and China's policy response is being monitored on the world stage.
What we're seeing in China is the pretty easily predictable and inevitable outcome of the third way, where governments try to hybridize collectivism in markets. Interventions in the economy, interventions in financial markets create moral hazards, and they corrupt the creative destruction, which is what makes markets, in particular competitive markets, work. But also they set the stage for future problems, like I discussed before, which invite larger and more distortion from interventions down the road. Politics is just, whether it's in China or whether it's in the U.S. or anywhere else, is a sort of an undertaking that favors and sort of provides incentives for short-term action without long-term sort of planning or corrective measures taken.